Should I buy a house or should I rent? Should I save for a down payment or is that a waste of money and waste of time? Do I really get a tax break after the tax law changes in 2017? Can I even afford to pay a mortgage? Hey guys, this is Ehab. Today we're going to talk about the option of whether you want to buy a house or rent a house. Should you buy a house or should you rent a house? This is probably one of the biggest decisions you're ever going to make in your entire life. I don't mean to scare you, but that's the truth. It is also the largest purchase that you will ever make in your life, assuming you're not going to be a billionaire and buy a private jet. According to a recent research study, it has been recorded that a higher percentage of US households are now renting compared to any point in time since 1965. There are several factors behind this. Mainly, people did not save enough to have a down payment. They want to be close to work in a city center, for example, or for the convenience of not having to deal with repairs, maintenance, or any paperwork that you have to do when you're purchasing a house. On the other side, there are tremendous benefits if you can afford to buy a house. You may build equity over time, no landlord rules to live by, more stability, you have the same payment for 30 years, tax benefits, not so much, we'll talk about it. And of course, you're free to upgrade or change anything with your house. Now let me walk you through the case of which one is most cost effective for you. Let's start with renting. Let's assume you're renting a property in Southern California. An average 3-bedroom house rents between $2,700 to $3,000 in Southern California, depending on the area. You will also have to put security deposit, which is basically the landlord protecting themselves in case you damage the property. And that's typically 1 month worth of rent, which is another $2,700 to $3,000. You will also need to pay for first and last month's rent, and that will be part of your lease contract that you'll have to sign on an annual basis. I will leave out water, electricity, utilities, internet, anything like that out of the calculation, assuming you're going to have to pay for it whether you're renting or buying a property. So let's keep it simple for our example. Let's assume that the rent is actually $2,700 per month. $2,700 times 12 is $32,000 per year. Now let's add the security deposit, $2,700. That will give you a total of $35,100 per year that you're paying. Now let's take the same property and same numbers and flip it to a purchase property. So you're buying that property. Same concept, same details, same size, same location. Let's assume you found a property for $400,000. If that will be your primary residence and your first time buying a property, you'll qualify for what's called an FHA loan, which is basically a Federal Housing Administration loan. This type of loan is backed up by the federal government. With this type of loan, you only have to put down 3.5% down payment. So $400,000 times 3.5%, you're putting $14,000 in down payment. Of course, keep in mind that you have to put a private mortgage insurance payment on top of that because it's an FHA loan. That will of course add to your monthly payment, but I'll show you how to get rid of it in a few. Now let's do the math behind how much you actually need to purchase a property. So as we said, let's assume the purchase price is $400,000. Down payment is 3.5% out of that, and that will be $14,000. Now let's assume the closing costs and other fees, they're going to amount to $7,500, which is typical. Let's add that to the mortgage as well. Property taxes, a little over 1%, so that will be out of the $400,000 value, you're looking at $4,200. Let's also add private mortgage insurance. That will be $3,000 a year. And last but not least, let's add home insurance. Let's assume it's $750 a year. Again, I'm leaving out utilities, I'm leaving out internet, I'm leaving out all these expenses because you're going to pay for it no matter what, whether you're renting or buying a property. Now let's go to the fun part, where we can break the numbers and I can show you how each number affects your finances. That way you can determine whether this is a good option for you, whether you can afford to buy a property, or is renting better for you. So let's add all the costs up. So down payment, $14,000. Property taxes, $4,200. Home insurance, $750. And private mortgage insurance, $3,000. That total is $21,950. And of course, if you're talking about mathematically, you have to spread out the down payment over 30 years because that doesn't cover only the first year. And besides, the down payment actually goes straight to equity. So It's really money that you're saving into your own house. In case you sell it, you're going to get that money back. So based on this calculation, your monthly mortgage payment is $2,307 per month. This includes principal, interest, private mortgage insurance, property taxes, and home insurance. If you just look at the amortization schedule for the mortgage, or do the simple math, or even get a statement from the company once you start paying the mortgage and see how much principal out of that you're actually paying, the number should be roughly $660 that you're paying in principal every single month. Of course, that number goes up by the time you're actually paying your more principal and less interest. This money you're actually putting back into the house, and you're getting it in the form of equity, which you can do multiple things with it. You can get a home equity line of credit, you can borrow on it, you can sell the house and get that money back. So basically it's money saved for you. My suggestion is that you subtract that amount out of your mortgage payment to know the true cost of how much it's costing you to live in that house or to even own it. So if we subtract it, your total monthly mortgage payment would be actually $1,647 per month. Realize that I'm not even mentioning the tax benefits for owning a house or even deducting your mortgage interest or property taxes. This is mainly because after the 2017 tax reform, this has very little effect on your personal taxes. So I wouldn't worry too much about it. It is still a deduction, but you can barely see the difference on your tax return because your standard deduction is so high that most likely you're not going to meet it anyhow. So this payment, $1,647 per month, this is your forever payment. It's going to be for 30 years consistent payment, not going to change. This also includes the $250 for the private mortgage insurance payment. Now let's talk about how you can get rid of that payment. So the way to get rid of the private mortgage insurance payment is basically you're going to have equity of at least 20% in the house. That payment is basically going to the insurance companies to back up the mortgage company in case you fail out to pay the mortgage back so they don't go bankrupt in case you stop making payments. So again, you have to have 20% of equity in your house in order to remove that private mortgage insurance payment. And there are two ways to do this. The first one, by just making your regular mortgage payments, which will lower your balance over time, and that will build more equity into the house up until 20%. Then you can remove it. The other way is when your house price goes up, you can then refinance to a conventional loan instead of an FHA loan. This will remove your private mortgage insurance payment and will lower your mortgage by $250 per month. And guess what? Now your mortgage payment is $1,397 per month. And it's not going to take you a long time to get to that number. It's probably going to take you a couple of years to just do that. So with the current historic low interest rates and with inflation, let's assume 3% per year, and if you're getting a low interest rate, also 3%, you are basically borrowing money for free. You're not really paying anything for it because the cost of inflation will eat up the cost of the interest that you are paying. Not to mention, your payment is going to be consistent for 30 years. It's not going to go up at all. If anything, you can refinance to a lower interest rate if the interest rate will go lower than that. On the other hand, if you're renting, I can guarantee you your payment is not going to be the same for 30 years. No landlord is going to keep the same rent for 30 years. So as long as you have a stable job with a stable income, you're not planning on moving in the next 3 years from this area that you want to plan to live in, then I would suggest that you buy a property. As soon as you find yourself that you can afford to do that, please go ahead and do it. That's it for today, guys. I hope that was helpful. Please let me know in the comment section whether you are buying or renting and what are the obstacles in your way for preventing you from purchasing your first property.